Hello, I'm Karishma Gagwani from Cafe Mutual, and today we have with us Ravi Gopalakrishnan, CIO Equities of Sundaram Mutual Fund, in this interesting episode of Baatcheet with Cafe Mutual. Ravi will be sharing with us his rich wisdom, which will help you guide your retail investors better. Hello, Ravi,
Hi,
and welcome
Karishma.
to Baatcheet with Cafe
Thank you
Mutual.
so much. Pleasure is mine.
The pleasure is all ours. Very happy to have you here.
Certainly.
So, Ravi, to begin with, we see that many experts tell investors to have moderate return expectation. But as we know, India is one of the fastest growing economy. And even if we look at the nominal GDP and inflation, and if we combine the two, so a return expectation could likely be 10 to 12%. But is this a moderate return expectation? What are your views on this?
So I think earlier when the economy was growing at a much faster tick, uh, perhaps expectation of a higher return was justified. And if you look at the history in terms of the benchmark returns, uh, long-term history, it is averaged about 14 or 15%. But because now we are entering this relatively lower growth scenario, while globally you might still say that we are the fastest growing economy, but net global growth has come down. So I think it probably makes sense to moderate that return expectation um, as such, and it's largely also a function of interest rates. And because rates in India, as you know, used to be in double digits at some point in time, but that's also moderated. So I think overall, I think it's perhaps makes sense to moderate that return, and I would think that 12 to 13% is a good enough return for long-term investors.
Okay, got it. So, since we are talking about India being one of the fastest growing economies, so in your view, what would those three sectors be which will play an important role in the growth trajectory?
Sure, I think that's a very important question here, primarily because we know that if you look at the last 50 years, the 70s belong to Japan, for example, right? 70s and 80s, and then China came into the picture. The next 20, 30 years, China had a phenomenal run. I think India is perhaps where China was in 2005. And if I were to kind of look at the next 10 or 15 years, I think it clearly belongs to India, both from an economic as well as geopolitical point of view. So from that perspective, I think one of the easiest choices from a sectoral point of view would be the financials, banking and finance, because that's really the growth engine of the economy. And for the if the economy does well, obviously that sector basically gets a massive tailwind. The second and most important segment here is the manufacturing and industrial segment. And why? Primarily because India was never really a manufacturing, uh, kind of a powerhouse for last several decades, and especially in the last 10 years, we haven't had any significant capex as such, which would basically kickstart the capex cycle. So, due to various reasons, right? We had, the entire banking restructuring, demonetization. Then, of course, we had COVID. There's so many events that happened. Capex cycle never really got off the block. It is only now, with the government's initiative of making manufacturing an important key element of the economy, that it's gaining traction. Whether it's PLI, Atmanirbhar Bharat, all those initiatives are actually helping the capex cycle to revive. And broadly speaking, if you see the capacity utilization of corporate India is already high at 80-85%. So there's no way that you cannot have a capex cycle, and this will last for the next 5-10 years. Similarly, if you look at the corporate balance sheets, the debt as a percentage of GDP has actually come down from almost 62% to 48%, and that's a big trigger because the balance sheets are much more leaner. There's cash on the balance sheet, so, and of course there's a buoyant equity market. So promoters are able and willing to raise capital for capital expenditure. So it's like, everything is falling in place for the entire manufacturing capex kind of a story. So that's a good long-term, uh, over the next 5 to 10 years. The third area is the consumer discretionary segment, because again, India, being where our consumption is, and I'd like to draw some parallel in terms of India, China, as well as Taiwan in terms of the per capita GDP, right? And typically, the moment you kind of cross the $2,500 per capita GDP, it triggers a sudden boom in consumer discretionary segment. And as a result of that, I think, like I was mentioning, India is exactly there where China was in 2005. And you see the automobile penetration, from like 16 per thousand going up all the way above 100 per thousand, that's just an example. Similarly, all the white goods and all the electronic, India is very, very underpenetrated in that sense. So if this per capita GDP goes up to 3,000, 3,500, and so on and so forth, I think the entire consumption pattern is going to change from your typical roti kapda, that kind of a thing, to more discretionary kind of spending. So I think these are the three broad pillars on which the Indian economy perhaps will surge over the next decade or so.
Okay. And since we've got a fairly good understanding about these three sectors, financials, manufacturing, and consumer durables, what is your take on the fund categories? So when it comes
Right.
to a retail investor, what are those three must-have equity fund categories for every portfolio?
So I would say that if you want to make your life simple, and I think it's always good to make your life simple, especially when you're not involved on a day-to-day basis and tracking the various funds and their performances and all of that. I think the easiest thing to do is a multi-cap or a flexi-cap kind of. I'm giving a very generic name, and there are multiple uh, categories within that. It could be large and mid-cap, or a flexi-cap, or a multi-cap. So because it gives a good flavor in terms of the large, mid, and small cap, and it allows the fund managers or the funds to be very, very flexible within that broad mandate. So I think these would be the categories that I look at for a slightly more conservative investor, excuse me, who are perhaps tasting equity for the first time. I think the hybrid category, when I say hybrid, it could be the Balanced Advantage Fund or equity savings, or even the hybrid funds. Especially now with valuations, and the markets having been rallied, a lot of new investors are trying to come into the market. Perhaps it may be not the best time, because to really put everything into equities at this point in time, because what if the market corrects from here? Your first experience is not going to be great, right? So it is always advisable to get into some of these hybrid products, because there again, the returns have been phenomenal over the last 3 years. And so I think these would be some of the broad product categories, depending on the risk return profile of the investors.
Got
And of
it.
course, for the more evolved kind of people, you can pick and choose a combination of the large cap funds, mid cap funds, and small cap funds, and create your own mix in terms of where your asset allocation, you want your asset allocation to be.
Got it. Well, thank you so much, Ravi, for sharing your valuable insights with us. And thank you, everyone, for being a part of Baatcheet with Cafe Mutual. We'll be back with our next episode soon. Until then, goodbye.
Thank you so much. Always a pleasure.
Thank you.